From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, April 2nd. It's Jobs Day. You're listening to the HPS Macrocast. I'm Matt McDonald in for Tony Fratto this week. And I'm here as always with John Fagan and Brendan Walsh from Markets Policy Partners. It is Jobs Day. We just got the jobs numbers. A big number today, 916,000 jobs created in March. It's kind of a nice anniversary present of the pandemic, I suppose. Last March, we lost 1.7 million jobs, and that was kind of the first downturn before we took a nosedive in April. Here we are a year later, and we're starting to see the recovery. It's worth noting that U.S. is passing the mark of 100 million Americans having at least their first dose of the vaccine. So I don't think that's coincidental that we're seeing broader distribution at the same time that the jobs are popping. Leading the charge on jobs is leisure and hospitality sector, which got the biggest whack through the pandemic, but the 280,000 jobs created there. And aside from that, pretty broad-based good numbers. Local education, local government that had a nice pop. Construction is up. Really good stuff across the board. Labor force participation is pretty stable, but we saw some reentry into the labor force generally. Brendan, what did you see in the numbers?
So I think the most encouraging sign was 500,000 women re-entered the labor force. So in September, close to 4 million women dropped out of the labor force because their kids weren't able to go back to school. So the fact that the schools are reopening is a great sign for the job market, but for the economy as a whole. It's a sign that we're healing. Even in DC, who has been slow to reopen, but the new CDC guidelines that changed the spacing from 6 feet to 3 feet has allowed a lot of schools to reenter, because a lot of it, the issue wasn't so much the teachers didn't want to go back, but you simply didn't have the space to let kids back because of the 6 feet. So I think that the CDC made a mistake with the 6 feet a long time ago, knowing how it's not droplets, it's aerosol, and masks really helped that. So that's a great sign for the economy.
What do you guys think we should? So this is a nice pop. This is the first big one since when was it that we had that? I guess we had like a couple of right after the April drop. Yeah, exactly. We had a couple of 2 million, 4 million, 1 million handles. But this is it's been a little while since we've had a big gain like this. What do you guys expect to see over the coming year?
So normally when you, as an economist, when you look at job gains, you do a regression and you see the trend and things like that. I don't think that analysis is going to be true this time. So I think we're going to see large job gains, but I don't think because we saw 700 that next month it's going to be a million. I do think it's going to be that, but I think especially come the summertime, where the vast majority of Americans will be vaccinated, and knock on wood, hopefully we'll reach herd immunity. And especially restaurants and hospitality services can come back. So I think we're going to see a couple months of like 5 million jobs, and then we'll be back to normal and go back to. So I don't think it's going to be a gradual job gains. I think it's going to be very chunky.
It is interesting tracking the virus too, even as 100 million have their first dose. I think it's something like half that have had a second dose if they need a second dose. And then there's there's the kind of antibody tests and CDC projections on how many people have gotten it. That stuff ranges between like 20 and 30% of the population, depending on state and that sort of thing. I don't know. It does feel like the recent, there's been a bit of an increase recently in cases, but it feels like a bit of a dead
and a lot of that
bounce,
is very
like it's the last.
Yeah, exactly. And that's very centralized in the Northeast, and actually Detroit's doing terrible. But the U.S. as a whole and the U.K. are doing great. The worry is the rest of the world is actually at peak infection rates and also peak hospitalizations. So we need to get we're not doing this alone. It's a globe,
Yeah.
So that's the next battle. So obviously, whether it's right or wrong, we were always going to vaccinate ourselves first. But that's a big goal for the United States, is to make sure the rest of the world can get vaccinated as quickly as possible.
Yeah, that's a really good point. And watching the vaccination rates in Europe, that is, Germany's going into a lockdown over the Easter holiday.
Canada just went in too. Yeah,
Ontario. Yeah, the rise in cases here, whether it's seasonal, whether it's just a pattern, and the vaccination distribution is lagging pretty considerably in Europe. This is fueling,
and that's what we know about the variants. They're not more deadly, but they're much more infectious. Like 4 times as more. So it's not shocking that more people are getting it.
And this is fueling a divergence in growth expectations over the near term, over the next coming quarters. Eventually, Europe is going to catch up. But over the coming quarters, there's a sense that the U.S. is so far ahead in terms of not just vaccination distribution, but also fiscal stimulus, and also just perhaps the risk tolerance of the population, the wherewithal to just go out there and get rolling.
So I got mine last Friday. So a week from today, let's meet at Bobby Van's, and then we'll hop on a bus and we'll go to we'll hop on a cruise.
Book your flights now, everybody. It does.
That's the kind of mindset that's been fueling the dollar. It's been fueling the outsized rise in longer dated treasury yields versus some of the global peers. And there was a sense coming into this number. Traders were bracing for it. It's a day where the bond market's only got half a day because of the holiday. The equity market's closed. There's not that much liquidity. And there was kind of fingernail biting around the potential for a big number like this on a day like this to upset the treasury market and create some more indigestion like we've seen. So far, so good. You don't want to put too much credence in one day's trading. But right now, the upside that we're seeing in 10-year treasury yields is pretty modest. It's like 3 basis points. Taking the 10-year up to 1.70%. That's right within its current trading range. Nothing really different on the 30-year bond. This is a pretty gentle upswing that we're seeing in the dollar today, and S&P 500 futures are up after hitting a record yesterday. So this is again consistent with the view that markets have done a lot to price in these kind of good numbers. Now, is that going to hold in Brendan's scenario when we're over the summer and start putting some really big numbers on the board for some of these key data points? I think that's the real question.
It's interesting. I mean, I think that's right certainly on the monetary policy side. This is what they're aiming for, and they're going to let it run. And, we'll see how long they let it run and what that looks like. I think that's right. The more we get into mid-year and that sort of stuff. I mean, we're still at 6% unemployment, which I guess
and
after the financial crisis,
it's really 10%. You basically add 4% because
of the dropout.
It's a misclassification where people said that they're not in the labor force, but it's because you dropped out because your kid couldn't go to school.
The interesting thing to me is what effect some of this starts to have on the fiscal side of the house, and we'll touch on infrastructure and the proposal in a little bit, but. The political will for more spending certainly is more of a knife's edge in terms of the divides in Congress. And, if big jobs numbers tell Joe Manchin that this seems pretty good, that could really change the policy frame on that side of things.
Exactly. And it's not even so much of the market is focused on the Senate too, where the House is on a knife's edge too. So I feel like the House is actually maybe when this whole thing plays out, the House could be the one that gums up the issue, what passes and what doesn't as much or even more so than the Senate. Yeah,
it's going to be. It feels like between the vaccines, between the jobs, I think people are starting to plan their travel, emerge from the pandemic hibernation. My favorite. I was watching CNBC coverage of jobs this morning, and my favorite recommendation was someone was like, put a buy on Match.com.
You're right.
To me, that's illustrative of the mindset that people are entering into for the rest of the year.
In the UK, a lot of the pubs are actually owned by a publicly traded company. I forget what the name of it is, but that's my recommendation.
That's your buy.
But going back to the Fed for very quickly, this scenario is just so different than anything else. Normally, if you had 5 million jobs, you'd be like, wow, the economy's out of control. But this, like, literally, restaurant closed because no one was allowed to come inside, or they were scared to come inside. The reopening the economy is not something that, should be troubling, that the economy is running hot. It's exactly what you want to happen. So the Fed is right in being cautious in terms of slowing things down. Overshoot. We know how to deal with inflation. You raise rates. Having runaway inflation like the market is worried about, in my opinion, would be the greatest outcome that we have in this situation. It means it worked. Yeah.
I mean, the only problem with inflation is not the solution. The problem is political will, if there's political will. And I just think the Fed is drawing down on a lot of credibility on that dimension.
Totally.
Yeah, that's certainly possible. We've talked with some clients about the Fed buying the inflation protected treasuries, tips. Do they have their thumb on the scale of one of the most key market-based barometers of inflation expectations? And that's a fair point. And you want to have a directional, even if the Fed is in that market, you don't want to discount the directional signals that are coming from it entirely. But like most everything in the markets, it's a mosaic. You have to put a piece together, really, if you're looking at market based reflections of inflation expectations, and tips are one of them, one of the main ones. But certainly if you're looking at some of the other things, it's hard to get an inflationary pulse with with a strong dollar and strengthening dollar. The dollar has been strengthened on an uptrend over the past couple of months. That's blown some of the froth out of the commodities markets. Oil prices have been range bound. OPEC came out yesterday and basically said, we're going into a taper of our output cuts. Oil prices have been sideways. That is a big signifier of inflationary expectations where oil prices are going and the way that the oil futures are. It's predicting downside price action over the coming months. This is it's still a very robust looking setup when you cast your eye across the markets. But what it doesn't look like is runaway inflation expectations right now. Gold, a traditional hedge for inflation, has been trading like lead for the past 3 months. So that's another signifier. None of these are on their own dispositive, but there's definitely a sense that reflation is relatively benign, at least through the lens of financial markets at this point.
Let's leave the alchemy behind for a second. Take a break. When we come back, I want to get some hot takes on the infrastructure debate that has unfolded in DC this week. This is the HPS Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
We're back with the HPS Macrocast. Matt McDonald here from Hamilton Place Strategies, and John Fagan and Brennan Walsh from Market Policy Partners. Guys, let's talk about the infrastructure package, the Biden administration rollout. I guess Infrastructure Week is here. This is Infrastructure Week, right? That everybody has been waiting for years. It's interesting. I think that there's a lot of kind of political support for infrastructure. There's a lot of economic support for infrastructure. It does seem like you get into the weeds on some of this stuff, and it's become a vehicle for lots of things. I've seen some movement on the political consensus about what this bill is and isn't, does and doesn't do. It's interesting. Again, we chatted about this in the last segment. It's interesting to see kind of the jobs numbers in the context of this. the spending that has been done last year, the coronavirus relief package that just passed. What did you guys see in the rollout? How are markets perceiving some of the discussions this week?
Well, the markets have been leaning into this announcement for months, ever since the Georgia runoffs delivered the Senate control to the Democrats. This had been in mind and in focus. Everyone knew that it was going to be the second part and that a faster, more emergency kind of package would lead. And we've already seen that pass the American Rescue Act, 1.9 trillion. And this is the follow on, the second part of the campaign. And how exactly it's split out was kind of a question, and what the total magnitude would be. The announcement, the details began to leak out the day before the announcement, and the price tag of 2.25 trillion over 8 years is a pretty chunky one, and that is just the physical infrastructure part of it. As we'll discuss a little bit more, there is the caring economy and more social programs follow on that is going to be announced sometime later in April. I think a couple of weeks hence here, and that, given the magnitude of this first part, it seems like the total price tag of these two put together, assuming they are a piece, then it would be closer probably to 4 trillion. But that is obviously being offset by pay-fors, the 15-year shift in corporate taxes from 21 to 28%, and a global minimum corporate tax rate of 21% to minimize the profit shifting to tax havens. That is designed to basically pay for the plan of the physical side of the plan, the pay-fors. This was obviously, money's fungible, so exactly what taxes pay for what is a bit of political hocus pocus, right? But clearly they wanted to link physical infrastructure with, having corporations pay for it, at least optically, in a way that the corporations are going to benefit from this increased productivity and these better facilities and so forth. So they are going to be the ones on the hook to pay the price tag. Markets really have, whether you're looking at stocks that are more growth oriented, your Caterpillars, these industrials, the materials, the banks who are going to be, the funding is going to be running through. These have been the ones that have been outperforming this year. The stay-at-home stocks, your Zooms, your Pelotons, your ARK investment, the real go-go and momentum plus stay-at-home pandemic winners have been lagging. This is part of, and this infrastructure, anticipation of this is part of that trade. Certainly the upside in treasury yields, there's that longer dated treasury yields responding to the growth expectations that this kind of fiscal stimulus brings, but also the treasury supply expectations. But the stability that we're seeing may have something to do with the fact that, this package is not a sugar rush into the economy, right? This is over 8 years. And we're going to talk a little bit more about, as the rubber really meets the road, so to speak, on infrastructure, there are lots of complexities. So the market isn't feeling like an overheating kind of dynamic in the face of this. And plus the pay-fors there obviously are a counterbalance.
Yeah. And you brought up a really interesting point on the tax side in paying for it, because looking at it strictly from, an investor standpoint, we know we need infrastructure. We know that these projects will have a sizable return on the investment. So it actually doesn't make sense to raise taxes to pay for it, especially if you're going to pay for it from the federal standpoint. You can borrow at 1.7% on a 10-year, which is really cheap. But more importantly, you actually have a private sector that would love to invest in this. So the most optimal way to pay for it would be to not pay for it, either just borrow or have the private sector pay for it. But as John brought up, you have that political standpoint where when you look at polls, actually it polls fairly highly. 2/3 of Americans are okay with, corporations paying for it. And John also makes a really important point that just because you allocated $1 trillion doesn't necessarily mean that $1 trillion gets paid for. So that'll be a very interesting debate going forward, is how much of the tax raises is actually to try to pay for these things and how much is actually a a policy decision to, over the long term, try to essentially redistribute wealth.
Yeah, this is back as President Biden knows well, because he was in charge of it, the American Recovery and Reinvestment Act after the financial crisis was, I forget, it was sub $1 trillion, but it was, but there was lots of focus on shovel-ready projects. And then President Obama had I forget his quote, shovel-ready didn't mean what, shovel-ready wasn't always as shovel-ready as we wanted it to be type of thing. There's a long way between here and there, right? It's not always a straight exercise of just dumping money into infrastructure. There's a lot of complexity to some of that stuff.
There is a high degree of complexity, and there's a reason that, we've been talking with infrastructure experts over the past few weeks. And one of the points that is very salient and sticks out is a statement that we heard: money was never the problem. And that is a worrisome formulation when you look at why haven't we done big infrastructure programs? And that speaks to the problem that you mentioned in that previous Obama era effort, which was basically they approved the money at the federal level. The money has to be spent to a great extent on the local level. You dump it into the coffers, and the mayor and the town manager look at each other and say, "What are we going to do with it?" The project pipeline in most places isn't very very well stocked with, as in the old parlance was, shovel ready. And this isn't your typical old infrastructure kind of spending. This isn't the surface roads bill. This is something completely different. In the past, we didn't really have an infrastructure policy. Our infrastructure policy was, if it needs fixing, fix it. If you can find the money. that's not really a policy. Now there's a real top-down federal infrastructure policy that is driven by imperatives to make America competitive in the future, to electrify and focus on batteries, chip, domestic semiconductor chip production. This is all has a flavor of basically this new recipe in which infrastructure has real national security ingredients in almost every facet. And sort of the elephant in the room when you're talking about infrastructure is, China, the rest of the world are passing us and leaving us behind, and it will leave us uncompetitive if we can't make some of this stuff work. And I think that imperative behind the scenes and the complexity of, once you get the bill passed, that's, not saying it's easy, but it's almost the easy part, getting the infrastructure bill passed. And then once you got the money, how do you make those projects fit your overarching federally set goals? It's a really hard thing to do, and coordinating federal and state, getting the expertise. We don't have the muscle memory for a big infrastructure program. We don't have people that are experts in it.
No, for big projects, there's only 5 people on Earth that can do these kind of things. Not just individual humans, but firms. There's not a lot of the bench is not very deep.
So where do you guys think this stuff goes? I think that it seems like there's there's questions around there's questions around what actually passes, what the shape of that looks like, both from what's in the packages, what the pay-fors are, all that sort of stuff. It feels like, as compared to the coronavirus relief package that was on a freight train and in the thick of one of the spikes and stuff, this feels a little different in terms of what's going to land, or how it'll play out in DC, all that sort of stuff.
Yeah, especially. So I think we get a big package, but I actually think that it's harder to actually raise taxes. So it's 50-50 in the Senate, but more importantly, it's what there's a 6-seat majority in the House. So actually, I think the House is going to be harder. You have 30, 40 kind of blue dog Dems that have to run every 2 years. So they're going to run in 2022. Yeah. Do they really want to run on significantly higher taxes?
Well, listen, the other aspect of that, and I think probably maybe underappreciated from people who have a little bit of a dated model on the parties is that, a lot of those Democrats are representing very wealthy districts, highly educated districts. I mean, it's weird to watch Democrats pound the table for the return of SALT. I mean, that is a tax provision that benefits very wealthy people.
It's basically the top 1%.
Yeah. So
it is. It's the top 1%.
Yeah. It has a quality of like, I do think that we're in a bit of a period of political scramble, and the parties have on some level, both parties are a little schizophrenic right now. And that's tough when you have a really tight margin in both chambers.
Yeah. And the SALT debate is really interesting too, because it's a lot of money. So if you eliminate it, you're basically giving a tax break to California and the Northeast.
Yeah.
Because 99% of Americans just take the $10,000 standardized deduction, and that's enough. It's just rich people that get to deduct their houses.
Yeah.
From a policy standpoint, it's a tough sell if you try to talk about the common man.
Well, let's take a break.
There are all sorts of other, the creativity of revenues and pay-fors that's possible that we'll see, whether it's the wealth tax or something else, come out attached to the social program and caring economy segment of this bill. They'll presumably have some different pay-fors there. Our expectation is really that when the discussions around capital gains tax, even a financial transaction tax, which given the lofty all-time highs in the markets, it is sort of getting some more attention here. The disconnect between how financial markets are running really hot and the economy is still struggling. That is ginning up some discussion about a financial transaction tax. And obviously the PR surrounding a Wall Street tax, that you can guarantee that would play pretty well in a lot of parts of the country.
From an out of consensus view, we think that the financial transaction tax is actually highly likely to make its way in. A, it can raise a lot of money, but B, after the GameStop and now the Archegos, it actually has a policy implication too, which can incentivize longer term holding and take away massive leverage and also the high frequency trading. So it's one that checks a lot of boxes that's not on the market's radar. But actually, I think as we get into this debate, it's something that's going to find its way into this bill.
Mm-hmm. It's definitely one to watch. But in our rule of thumb is basically if it's particularly controversial or relatively creative or colors, over into the side of something that may have a tough sell in mainstream America, it's going to come after 2022. The Democrats are looking at this midterm election with the same kind of urgency, I think, that they looked at November 2020. Maybe not quite so existential, but pretty close. And
meaning that you think that some of these tax provisions will be backloaded in the bill?
Yeah.
Well, I think that they'll probably not make it through. They may get proposed as part of the bill. We think that the proposal isn't really going to look. There's going to be a lot of difference between what is proposed and what finally comes through the legislative process. And so we think a lot of the pay-fors potentially that could get appended to the Caring Act part of the bill fall by the wayside and are sort of a statement of intent that may come back after the midterms. The Democrats are absolutely focused on widening their exceptionally razor-thin narrow margins in both houses and doing anything to jeopardize that in the next few years is not part of the program.
And that was kind of the narrative from the 2020 election that fell by the wayside because Trump was such a polarizing character, and then we had the runoff in Georgia. So the Senate and the Georgia and then the presidential election was really a referendum on Trump. However, the House, the Democrats lost a lot of seats, and that was much more a referendum on the Democratic Party. So it's 2020. if things stay static, I would expect the Republicans to actually take the House. So if you're 2022, sorry. So if you're the Democratic Party, they're not morons. They understand this as well as you and I do. Yeah, raising taxes on a bunch of people is not a great way to get reelected.
All right, let's take a quick break. We'll come back, talk a little bit about weeks to come, energy. We'll be back on the Macrocast.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on the HPS podcast channel on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
All right, we're back on the Macrocast. We talked a little bit about OPEC and oil prices. John, what's the hot take there? What should we be looking for in the weeks to come?
Yeah, well, the Saudis have done an incredible job keeping the fractious cartel and its allies together. Russia is not notoriously cooperative, and they've really pulled a rabbit out of a hat in their monthly meetings to keep this supply cuts train rolling. This is the meeting where they admitted that it's time to start tapering. The oil prices took it pretty well. They've been range bound. They sold off going into the meeting. And so there was a little bit of a rally afterward. Appears to be a slingshot effect. And with the supply picture kind of on a set it and forget it taper trajectory, the big swing factor is going to be demand. And this week we saw a lot of questions about demand given the announced lockdowns last week in Germany, this week in France, Ontario, and so forth. The idea that this recovery is going to be uneven, and certainly the emerging markets are lagging where there's a lot of oil demand. They're lagging in the vaccination response, of course. And so
really does go back to your point on kind of the global aspect of getting out of the pandemic.
Yeah. And so global demand is really going to be a swing factor. So every week's data is going to be in focus. Next week, we've got global purchasing managers indexes, the service and combined components, giving us a sense of how the recovery is going in a lot of parts of the world. Again, we've got another U.S. initial jobless claims, and otherwise a couple of central bank things. We've got the Reserve Bank of Australia, which has been pretty militant about the steepening of its yield curve. So we'll see if they come out tough talking again. And we've got the FOMC meeting minutes for any further insights. But the Fed has been basically as unified and consensus on their messaging as I can even remember. So
yeah, and the Fed is the one that writes the minutes, so it's not like you're going to get a surprise that they didn't want to come.
All right, great. Thanks everyone for listening to the HPS Macrocast this week. I'm Matt McDonald with Hamilton Place Strategies. Thanks to John Fagan and Brendan Walsh of Markets Policy Partners. Have a great holiday weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.